Welcome everyone, and thank you for coming. Good morning, good evening, good afternoon, depending on where you are. So we're very happy to have Neil Pearson with us today, who is going to speak to us about a simple rule for complex options. And Neil would welcome questions throughout the talk, so no need to wait until there is a break. So anytime you have a question, please just jump in, either raise your hand or you can jump in with your voice. So Neil, the floor is all yours. Thank you.
Gotcha. Thanks very much. And thanks very much to the organizers for having the paper on the program. And thanks to everyone for coming. I'm going to talk about mostly about complex options trading, which I think might be interesting to people because I think it might be new to a lot of people. My co-authors are Sue Lee, who's at the U.S. Securities and Exchange Commission, and David Musto from the Wharton School. And because Sue's at the SEC, we have to give the obligatory disclaimer. Okay, so options trading has grown explosively since the first electronic limit order book on the ISE in 2001. And then it grew very rapidly until about 2010. And then there has been another more recent explosion starting around 2020, apparently driven by retail investors. I'm not going to talk about options trading in general, but about complex options trades. So what's a complex options trade? It's a trade in which a package of options, for example, a straddle or a vertical spread or a calendar spread, are offered and traded at a single net price. Okay. There can be nowadays on at least one exchange up to 100 legs in the package, but the most common complex trades are various kinds of spreads, vertical, diagonal, and calendar spreads. That actually accounts for the bulk of complex trading. And then secondarily, trades that academics usually interpret as volatility trades are a smaller fraction of complex trading. And we're going to talk about what role do these trades play. Okay, so what happens, what it is traded at a package at a single net price. So for example, if there's a call that has a value of about 225 and another call with a higher strike that has a value of say 150, and you wanted to execute a vertical spread of buying the lower strike call and selling the higher strike call, you would offer that vertical spread at a single net price equal to, in this example, about 75 cents. Okay, and now 11 of the 16 options exchanges provide protocols that allow you to execute complex packages at a single net price. Okay, what happens then, the complex trades are not reported as complex trades per se. What happens is that the trades are reported to Oprah, which then disseminates them. But what happens is, so this complex trade was traded at a single net price as a package, but then the legs are reported along by Oprah along with the other single leg trades, and the net price is allocated to the legs. So you won't see the complex package reported. What you'll see is that the two legs are reported separately. When the legs are reported, there is a trade condition code that indicates that they were part of a complex package, but it doesn't indicate what complex package they were part of. Okay, we're going to have an algorithm to identify the trades. It primarily exploits the fact, the simple idea of the algorithm is it exploits the timestamps, right? If there were 4 legs, 4 single trades that were flagged as being part of a complex package, and they're reported in the same millisecond, it's almost certain that those 4 were traded as a complex package, because it's not impossible, but it's unlikely that multiple complex trades are reported in the same millisecond. Okay, so what happens, right? There are various trade condition codes, several condition codes in our data. There's a different set of condition codes in more recent data, but in our data, there's several condition codes that allow us to identify whether the single leg trades reported by Oprah were part of complex packages. Okay, so here's an example of sort of the stream of complex trades in the SPY, right? Over on the right-hand side, there's a condition code. That's how we know they were complex trades. And I just want to give you the main idea of how we identify what the complex packages were. Okay, so these trades are in the order they were reported by Oprah. Okay, and you look at the first 2. Okay, and they were reported in the same millisecond. You look at the timestamp. They were part of a complex package. They were reported in the same millisecond, same strike, different expiration dates. We identify the first 2 trades as a calendar spread. Okay, you look at the next 2 trades. The condition code indicates each of them was part of a complex package. They were reported within the same millisecond. Oh, they have the same expiration, put and call with the same expiration, different strikes. We interpret these as a strangle. The next set of complex trades, trade condition code indicating they were a complex trade, reported in the same millisecond, same expiration date, all puts, a low strike, a middle strike, a high strike in the ratio of 1, 2, and 1. These 3 trades were a butterfly spread. So we basically go through the trades and group the trades into complex packages. It's actually a little bit more complicated than this. It's infrequent that multiple trades are reported at the same time. Well, some issues. There are trade reporting lags, especially for trades executed manually on the floor. So it's a little bit more complicated than this. We have a bunch of rules to deal with it, but this is the main idea of how we identify complex trades. Okay, someone raised their hand. Someone has a question?
Hello, Professor. I was wondering, what is the information of the size, like buy or sell?
Sorry?
Can you hear me? Where can we see the side?
We don't see the side here. So these are trades that are reported. We're going to assign trades from the midpoint computed at from the single leg books, right? So we're going to estimate the fair. Let's suppose we look at the strangle, right? And we don't know whether this was a purchase strangle or a sold strangle, but we estimate the fair value of the strangle from the midpoints on the single leg limit order books, and then sign trade by comparing the trade price to the midpoint estimated from the single leg limit order books. So of course, it's an estimate of the trade direction, not the trade direction, but that's what we do. Other question? Okay.
We have a question in the chat. which asks, Rabi Mosavi asks, can you please clarify who is able to see these complex trades in real time and how often market makers execute them at the counterparty of these complex options trades? Thanks.
So, so in real time, the exchange members who subscribe to the feed can see the complex limit order book. So let me defer talking more about that till I talk about how the complex limit order book functions. Okay. So, which is actually the next slide. So a little bit more about that. So in the simple limit order book, that is the limit order books for single leg trades, I think everyone's familiar with them. Liquidity market makers make a two-sided market in the simple limit order books, right? So market makers are central to the simple limit order books. There are some particular allocation rules, right? Some of the options exchanges use price time priority. Some of the options exchanges are pro rata exchanges. They have different rules about allocation, but typically market maker gets a heightened allocation when the market maker is at the NBBO. Okay. And then also for single leg trades, there are price improvement auctions, apparently often used to internalize trades, where an exchange member who brings an order to the price improvement auction, it brings a customer order and simultaneously a proposed contra order. And then other exchange members have 100 milliseconds to potentially improve upon the contra order. But anyway, the simple limit order books are heavily based, or involve market makers making two-sided markets in the simple limit order books. The complex limit order book operates quite differently. Typically, market makers are allowed to post two-sided quotes in the complex limit order books, but they typically don't. And one reason to think about it is that, for example, think about why for example, in the SPY, there are about 6,000 combinations of put and call, time to expiration, and strike. So there are about 6,000 options on the SPY. And there aren't quite infinitely many possible complex trades, but there are a tremendous number of complex trades. And one reason why market makers won't don't make a continuous two-way market is that there are too many possible complex trades. Instead, the way it works is the customer or a proprietary trader will post a limit order on the complex limit order book, and then market makers monitor the book and decide whether to execute against the customer order. So the way to execute a trade in the complex limit order book is to cross the fair value, post a limit order that crosses the fair value, and then Citadel sees that you've crossed the fair value and their algorithm sees that you've crossed the fair value, and then they execute against you. Okay, so it's very much the trades are trades in that way. Okay, that's one complex execution protocol, the limit order book. Secondly, there are also complex price improvement auctions, which are similar to the simple price improvement auctions in the complex price improvement auction. An exchange member brings a trade, say a customer order, and simultaneously brings a proposed contra order, and other exchange members have 100 milliseconds to potentially better the contra order. And then the third execution protocol for complex trades is from the beginning of options trading, it's been possible to execute complex trades on the exchange floors. And 5 of the exchanges still operate floors, which are typically used for large institutional trades. Okay. So how do we sign trades? This is get back to the question, right? So we have a vertical call. And let's suppose with a strike of 50, it has a value of $6. At a strike of 50, well, an option, a call with a strike of 50 has a value of 6. Call with a strike of 55 has a value of 155. So the net value of the vertical call is 445. Let's suppose it trades at that price. Then from the single leg limit order books, we see the MBBOs. We can compute the synthetic MBBO, which was what it would cost you to cross the spread on both sides. The midpoint from the single leg limit order books is in this example, 4.475. So we compare, the way that we sign trades is we compare the trade price to the fair value, to an estimate of the fair value that comes from the midpoints of the single leg limit order books.
Hey, Neil, I have
Yep.
a quick question.
Mhm.
Like, can you go back 2 slides on the different mechanisms for the,
Yep.
yeah, this one, the next ones. So for my question is regarding like for the complex trades that was actually executed. Do you see there was a different protocols regarding whether they go through this central limit book or they go to the auction? Because I know NASDAQ is actually have this mechanisms that if this order is actually first, like the combination of those single trade is first time appear in the orders, they usually go through this auction first, and then in the futures, as long as those strike prices and maturity appear repeatedly, they will assign this this unique flags to those trades, and in the futures, it's no longer through these auctions, but rather through this central limit books. So I don't know whether that's also the same in the SIBO or NIC, but it seems like it's not those 3 different approach or 4 different approaches is at different stage of the options or different stage of the lifespan of the complex options.
So I'll let Sue jump in to correct me, but one thing I'll say is that most complex trades is through the limit order book, and that there's no sequence, right? If let's suppose let's suppose it's a customer order, right? Well, the customer or the customer's broker will send it to one protocol or the other, right? It's not that it's first sent to one protocol and then to another.
Mm-hmm.
I mean, it's a little bit more complicated than that because orders in the complex limit order book can interact with the simple limit order book if they're marketable against the simple limit order book. But orders are sent to one protocol, executed on one protocol or another. And that actually appears. Some people think that the complex price improvement auctions are used primarily to internalize trades, though that's not something we take up in this paper.
So I can add something related to like complex order, routing. So you might want to take a look of the SEC's best execution proposal. So it provides some stats on the rate of internalization through complex, auctions. It is something about 80%, which means that if a broker dealer like Citadel would like to internalize, the complex order received from, their customers, most likely they would route the order to a complex auction instead of a complex limit order book. So the internalization rate for the complex limit order book is pretty small. It's something like 20% according to the SEC best execution proposal.
Oh, so one thing for background that people might know, right? Internalization in the options markets works differently than in the equity markets, because in the options markets, every options trade has to occur on an exchange. So internalization in the options markets means a mechanism to route the order through the exchange, but actually take the order yourself while routing it through the exchange. There's no off-exchange internalization. And then I see Pankaj Jain asked a question about, is there any mechanism or platform to cross options orders at midpoint? And the answer is no. Okay, moving on, okay. So
can I do a follow-up question? So is it no competition, or is there regulatory restriction? How come people didn't think about midpoint crossing in the options market?
I actually don't know why there isn't any.
Industry has power, like what kind of monopoly is this? So, but anyway, thank you.
Okay, so I want to talk a little bit about, I guess I'm running low on time, so I should talk about, I'm going to skip some of this. So the question is, why do a complex trade? And so the first textbook hypothesis that comes to mind is you want the profit and loss and risk exposure provided by the complex trade. And I'll go through this quickly, right? John Hall's book explains what the P&L and risk of a calendar spread is. You know, Fidelity tells you, oh, you're trading, if the calendar spread trades the volatility skew, it's all about difference in theta, that is time decay. CME talks about, you know, gives you a reason to trade a particular spread as you want the risk exposures, right? Other people talk about the reasons to trade a particular spread is you want the risk exposures provided by that spread. We're actually interested in alternative hypothesis. One reason to trade a calendar spread is that one of the options is coming close to expiration, and you want to adjust the expiration of a simple options position. So you actually aren't interested in the risk exposure of the calendar spread, that you use the calendar spread to close one simple position and open another simple position. And it's very clear in the case of the calendar spread why you might want to do that with an option that's close to expiration. And it's actually worth going back here to see this. Whoops, I went too far. Right, just look at this first one that I said is a calendar spread. The trade date is the 18th. One of the legs had only 3 days to expiration. Right, so it's natural to view this as you're closing out the leg with 3 days to you're closing out a simple position in a trade with 3 days to expiration and opening a position in a trade with about a month to expiration, in an option with about a month to expiration. Okay, so that's really the hypothesis that we're going to focus on. Okay, diagonal, same story. An alternative hypothesis, and our hypothesis for a reason to trade diagonals is you close out a position in an option that's close to expiration and open a position in an option with a further expiration. And then even for verticals, people in the industry will talk about the risk exposure of vertical spread. I'm running low on time, so I'm not going to spend much time on this. But another reason we're interested in a hypothesis that a vertical spread can adjust to simple position, right? A vertical spread can be used to close out a position in one strike and open a position in a different strike. And you might want to do this if one of the strikes is in the money. You might want to close out a position on an option that became in the money because you don't want to exercise it, or you don't want to have it exercised against you and open a new position. Or if the stock moves away from the vertical strike, from the strikes, the vertical spread becomes almost worthless, and you might want, if you have a simple position and the stock moves away from the strike, that simple position becomes almost worthless, and you might want to adjust the strike in order to reestablish your exposures. Okay. So let's talk about the sample. One fact that people who don't pay attention to the options markets might not know is that options trading is extremely concentrated in a small list of well-known names, right? Actually, this slide says it's from NASDAQ, and NASDAQ provided the data, but this is options trading across all exchanges. And this handful of well-known symbols accounts for about half of options trading volume, right? If you subtract the other ETF, this handful of well-known symbols accounts for about half of options trading volume. So the reason I show you this is to explain the sample construction. We're basically going to have the 30 most actively traded single stock symbols and the 30 most actively traded ETP symbols. 30 most actively traded ETP symbols. Interestingly, it's hard to read in here, but for single stocks, there's more trading in calls than puts. For the ETPs, there's more trading in puts than calls. Okay, some initial summary statistics. One of the findings is that relatively simple spread trades account for about 60% of volume. And then if you look at trades that look like they're intended to roll simple spreads, there's some more volume there. So the combination of simple spread trades, calendars, diagonals, and verticals, and trades that are intended to roll simple spreads is actually more than 60%. Trades that are usually interpreted as volatility trades are a relatively small fraction of trading volume. Okay. Broadly similar results in options on exchange traded products. Okay, some regression results. I'm running low on time, so I'm gonna skip what are really some sort of simple exploratory regressions. Though the one finding that comes out of the simple exploratory regressions, or one finding, is that complex trading volume is highly correlated with the price level. Okay, and we also have an event study. And then it makes sense to look at a couple of pictures. This is just calendar spreads in Apple. Okay, and so what's interesting, in calendar spreads in Apple, where the spread is in the money. Okay, and there's several things. Okay, so when Apple goes down, there's almost no trading volume in the money calendar spreads. when Apple goes south, in the money calendar spreads involving calls. Apple, for a long period of time, has an extended decline, almost no trading in the money calendar spreads in calls. Apple goes up, almost no trading in the money calendar spreads in puts. Sorry, these are, I showed you for diagonals, sorry. Apple goes down, almost no trading in diagonal spreads where one leg is in the money. Apple goes up, almost no trading in diagonal puts where one leg is in the money, right? So we look at this, and this is very suggestive that these diagonal spreads are used to roll positions to later expirations. Why are there no, if Apple goes down, suddenly all the calls are out of the money. And so there are no existing there are very few existing in the money call positions. Oh, if there are very few existing in the money call positions, there's no need to roll those in the money call positions. Apple goes up. There are very few existing in the money put positions. There's no need to roll those in the money put positions. Similar picture for calendars. Apple goes down. There are very few existing in the money calls. Oh, no need to roll those in the money call positions. Very little trading volume. Apple's going up. Very few in the money puts. No need to roll positions in the money puts. Okay. So anyway, so this is kind of suggestive of the hypothesis spreads trades in rolling positions. It actually, those figures suggest that spread trades ought to be related to recent returns. We're going to estimate some regressions where the left-hand side variable is the volume in a particular spread trade. The right-hand side variable is the 10 most recent daily returns in the underlying stock. Okay, and what we're going to find is for the different kind of spreads, volumes are related to recent returns. Call volumes are positively related to recent returns. Consistent with people adjusting, using complex trades to adjust positions once calls become in the money. Volumes of put spreads are negatively related to recent returns, consistent with traders using complex trades to adjust put positions that have recently become in the money. Okay. Actually, most of the coefficients out to lag 10 are also significant, but there's not enough room to show them on the slide. Similar results for calls and puts on exchange traded products. Okay, and then here we do something that I wanted to save. Oh, I see looks like there might be a question in the chat. It seems from your picture that most trades presume momentum in underlying stocks rather than price reversals. I actually don't agree, right? So what's going on in the story I have in mind in the picture is people have some simple positions in calls. Apple goes down. None of the simple call positions, or very few of the simple call positions, are in the money. Okay, and so if people are using calendar spreads to adjust in the money call positions, if people are using diagonal spreads to adjust in the money call positions, that predicts that when there are no in the money call positions, there are no diagonal spreads. The alternative story, the alternative hypothesis that people trade calendar spreads because they want the exposure, doesn't have any prediction about how trading volume is related to past returns. So my story is that the hypothesis that people use diagonal or calendar spreads to adjust simple positions of in-the-money options predicts no trading volume if past return was negative. The alternative hypothesis that people trade calendar spreads because they want the risk exposure from the calendar spread predicts that there should be trading volume even though the previous return had been negative. Okay, so then we really want to get at the idea, try to get more directly at the idea of how are people using complex trades, right? So we're really interested in the question of, are people using complex trades to close one simple position and open another? Now, one of us can look at the regulatory data and can answer that question and can answer that question exactly, but we're going to see what can be learned from the publicly available data. In particular, we're going to see what can be learned from changes in open interest of each option series. So the unit of observation is going to be a stock day. The left-hand side a stock day option series, an option series day. The unit of observation is an option series on a day. The left-hand side variable would be the change in open interest. The right-hand side variable will be the day's volume in that series decomposed into the volumes that come from various types of trade. So we have a very complicated notation, but for example, one of the right-hand side variables will be the volume that comes from a vertical ratio, from vertical ratios where the first leg is in the money. Another variable will be the volume from vertical ratios, their second leg, when the first leg is in the money. Anyway, we're just going to decompose the day's volume into the parts of volume. You know, if there are 10,000 contracts traded, 500 come from the one particular set of complex trades, 1,000 come from a different kind of complex trades, etc. Okay. And then the trick is going to be, how are we going to interpret the regression coefficients, right? Left-hand side, change in open interest. Right-hand side, volume in that series that comes from various kinds of complex trades. And the trick is that whether volume or the complexity comes from the fact that whether volume causes a change in open interest or no change in open interest depends upon the counterparty's position. So let's suppose a customer buys a contract. If the counterparty, typically a market maker, was already long that series, then the customer long position goes up by 1. The counterparty long position goes down by 1. There's no change in open interest. But if the customer who buys a contract trades with a counterparty who had no position or was short, the customer trade increases open interest by 1 unit. So the way to understand this So to get an example of how this would work, if complex trades always open new positions and the counterparty is equally likely to be long or short, then the regression coefficient should be 1/2. If complex trades always close positions and the counterparty is equally likely to be long or short, then the regression coefficient should be -1/2. So actually, really, so regression coefficients larger than 1/2 really strongly suggest that most complex trades are opening trades. And, regression coefficients close to -1/2 strongly suggest that most or almost all complex trades are closing trades. Though in particular, the complexity comes from the fact that the magnitude of the regression coefficient also will depend upon the counterparty's position. But regardless of any assumption about the counterparty's position, positive negative coefficients imply that there are more opening trades. Positive or negative coefficients imply that there are more opening or closing trades, regardless of what you assume about the counterparty's position. I see a question in the chat. So the question is, can you use your data to determine how much of this volume is linked to 0-day options? Yes, we can. We don't do it in this paper, but we can study 0-day options and use some of these ideas to study 0-day options. That's a paper for which we have a lot of the results. And someone, unfortunately, that someone might be named Neil Pearson, is supposed to write the draft in the next month. So we have results for a paper that looks at 0 DTE options, but someone needs to write it. Unfortunately, that might be my job. Okay.
There is another question
sorry.
from Yandin. Thanks.
Go ahead,
Hi,
Yandin.
Neil. I have another question regarding the interpretation that the complex trades are always open.
Yep.
One alternative explanation would be the margin requirement for open complex trades is actually lower. So when people open position, they can actually, when they exit position, they always decompose their legs. So for example, if you're doing a spread trades, the margin requirement would be the spread differences, the strike price differences.
Yes.
But if you're doing a long position and a short position separately, the short position will require 20% of the underlying security is times 100, right? So if you're doing it seems like most of them are doing open position for the complex, but the alternative explanation is because margin, not because they are rolling. Do you have any test?
So I agree. I mean, if you want to do a spread, it makes sense to do the spread in the complex book, both because of margin reasons, but also because we have a different paper that were some results that suggest that effective spreads in the complex book are less than in the simple limit order book. So there's at least 2 reasons why you would want to do a trade in the complex book. I mean, 2 other reasons. That is, if you want the exposure, we're actually going to try to present evidence that you don't actually want the spread, but you're just you never actually have the spread position. You're just using the complex spread trade to adjust a simple position. And so maybe I wasn't exactly clear, right? We're going to use this sort of analysis. We're going to look at the volumes in different legs, and we're going to conclude that some of the legs are closing positions and some of the legs are opening positions. It might be a little bit clearer if we look at the results. So this is one set of regressions. We have a couple set of regressions. There's not time to show them all, but this would be like trades vertical ratios the first leg, that is for a call, the lower strike leg, is in the money volume, and the coefficients are large and negative. So we interpret this as trades when vertical ratio trades, when the first leg is in the money, are predominantly closing trades. Vertical ratio trades when the first leg is out of the money are predominantly opening trades. Vertical ratio trades, volume in the second leg when the first leg is in the money, are predominantly opening trades. So actually this first row here and this third row, we interpret this as their rolling position. So this is when the first leg is, this is volume in the first leg when the first leg is in the money. This is volume in the second leg when the first leg is in the money. So these trades, to us, we think this is compelling evidence that most of these trades are rolling positions. When either the first leg is out of the money, volume in the first leg when the first leg is out of the money, volume in the second leg when the first leg is out of the money, are opening trades. Okay, and then, so I'm not going to have time to go through all the results, but this is how we draw our conclusions, right? We see when the first volume in the first leg, when the first leg is in the money, those trades close the first leg. Volume in the second leg, when the first leg is in the money, those trades open the second leg. I'm not going to walk through all these results. I don't have time. But this is how we draw conclusions that a large fraction of these trades are trades to roll positions. Okay, I know I'm over time already, so I'll just say one or two things about volatility trades. We really don't have an hypothesis about volatility trades. One thing we actually discover, one fun little fact, is what's this ratio MK? This is the ratio of the middle strike of a straddle to the stock price. So the middle strike of a sold straddle on average is about 5% out of the money. The middle strike of a sold butterfly on average is about 8% out of the money. So actually this tells us an at-the-money straddle is a volatility trade, and at-the-money butterfly is a volatility trade. The typical straddle and the typical butterfly is away from the money. Thus, it's actually a directional trade. Okay, and then the other thing we do, I know I'm over time, so I'm just going to say some quickly, is we use some similar regressions, open interest regressions, where the left-hand side variable is change in open interest, the right-hand side variable is components of volume. You see here most of these coefficients, most of these volatility trades are opening trades. The one exception to this is that some of the butterflies and condors are for exchange traded products. We get some results. People are buying volatility with straddles and selling volatility with strangles. I'm over time, so I think I should mostly just stop. Anyway, so we haven't walked you through all of the conclusions, but we showed some of the regressions that we used to draw these conclusions. And the sort of main takeaway from our open interest regressions is that for stocks and ETPs, majority of the trades are vertical, calendar, and diagonal spreads, and these appear to be primarily executed not because the investors want the risk provided by the complex package, but rather to adjust simple positions. The other thing we saw is that volatility trades are actually a small part of options trading, and that a lot of the trades that academics often interpret as volatility trades actually appear to have a directional component, right? The typical straddle and the typical butterfly is actually about 5% or 8% away from the money, which makes these directional trades rather than volatility trades. Anyway, my apologies for running over time, but thank you for coming.
Well, we still have a few minutes for questions in case anybody wants to ask questions, but thank you very much. So we try to end a little bit before the end of the hour, just so we have some time for clarifying questions. Anybody? So I was actually wondering if, because you said there was quite a rise, and we all know there was quite a rise in the retail options trading. Has this changed as like retail traders entered this market, or is it always been the more directional trading?
Okay, so one thing I will say about this, so our sample period here was 2016 through 2018, and during this sample period, complex trades were about 36% of ETP volume and about 24% of single stock volume. Those percentages have gone down with the recent explosion in apparent volatility in apparent retail trade, right? So during our sample period, round numbers, complex trading was about 30% of options volume. It's less in more recent data. It appears that the retail idiots are not doing complex trades, right? So that the explosion in volume is mostly due to single leg trades rather than complex trades. And of course, as I think a lot of people already know, a lot of the explosion in volume is in very short-term options and zero days to expiration options. Oh, there's a question in the chat. Yeah, so recapitulate the difference between single stock trades and ETP trades. So single stock trades, calls, there's more trading in calls and puts. For exchange traded products, which is mostly exchange traded funds, there's one exchange traded note in our sample. For exchange traded products, there's more trading in puts than calls. And for the ETFs that are kind of feel more like indexes, there's relatively more put volume. So actually what we see is that in single stocks, there's more call volume than put volume. On average in ETPs, there's more put volume than call volume, with relatively more put volume for the broader based ETPs that are more similar to stock indexes. And there's also, more complex trading in ETPs than in single stock options. So, to some extent, options trading in ETPs feels more like options trading in the indexes. We're actually in something like the SPX, more than half volume is complex trades. Right, so the ETPs kind of feel like, which is kind of not surprising, but options trading in the ETPs is kind of in between options trading in single stocks and options trading in the broad-based index options. Oh, Pankaj Jain raised his hand.
Yes, thank you. So I want to collect your thoughts on what's the best way to improve liquidity in the options market? Is it to reduce complexity or reduce the number of maturities and strike prices? Like, it's very fragmented, right? Or is it to allow like more innovative order types like midpoint? orders and stuff like that. And is the option market illiquid? Or maybe that's a more basic question first.
So that's an interesting question, right? For some of the names, total option trading volume is enormous, but it can be spread across 1,000 or 2,000 different series, right? So many of those series, maybe there's 2,000 Meta, that is Facebook options traded today, right? And there's a tremendous volume in Meta options, but a large fraction of those 2,000 series won't trade today. So that's so are those options liquid, illiquid? Collectively, Facebook options are extremely liquid. Many of the individual options are extremely illiquid. I don't know whether that's a problem or not, right? I mean, the illiquid options, you can trade them, right? Because market makers maintain continuous two-way quotes. I mean, I think the issue is that the sense in which the options market is illiquid is that quoted spreads are very wide.
Right.
Right. And then how do you deal with that? People will trade with non-marketable limit orders, right? Cross the fair value with non-marketable limit orders. That's one strategy. Complex price improvement auctions, complex trades seem to have lower effective spreads, but I agree the challenge to the extent there's a problem, the problem in the options market is that quoted spreads are extremely wide for some options. So it's just deadly to cross the spread. Is there a way to address that, right? Because then, people have to do things like trade with non-marketable limit orders to trade at anything like a reasonable effective spread.
Thank you. Yeah, so it is a problem, I guess. And I don't know if you thought of spreads being too wide, but you seem to be agreeing. So then the midpoint would be a good solution, but I don't know why nobody thought about it, or is there any constraint from the regulators?
Well, I think one reason why options market makers are so central, right, is that there are 2,000 whatever Google series traded, right? If some of those series won't trade today, some of those series will trade 1 or 2 times today, right? So it's for most of those series, it's unlikely that 2 customers want to trade on the same day, right? So this midpoint, the midpoint, to have a midpoint to try to match 2 customers is just not going to work because the trading is spread across so many different series. So for most of the series, the trading almost has to be against a liquidity provider. So Tom has a hand raised.
Yeah.
So before we take Tom's question, I just know that some people would have to leave at noon, and I just wanted to say thank you to everyone who was here, and also to let you know that in 2 weeks we're going to have another talk and the talk is by Taisia Sikorska, from PhD student on the market from London Business School, who will be talking to us about the effects of benchmarking on securities lending. And now, Tom, sorry to interrupt. Thank you. And Tom, you're now muted, but go ahead with your question.
Okay. Yeah. Oh, okay. So quick question. You said the effective spreads are lower in complex trades, but do we know what the fill rates are like?
No. So this is an issue. This is why I didn't push that idea too very hard, because the trading mechanism is different. It's not clear what the right benchmark is for complex trades, and we don't know the fill rates. So I said they seem to be. I didn't push that idea very hard, precisely because of the issue you raise.
There is also a question in the chat.
So I'll let Sue answer that question if he's still there.
Well, I cannot answer this question. This is related to non-public information.
Okay. and I don't know the answer. And if I did know the answer, it would be because Sue told me, and I wouldn't be allowed to answer that question either.
So maybe it's a comment rather than a question then. Any other comments or questions? Well, as it turns out, we're perfectly on time, so we're at noon. Again, thank you very much, Neil, for joining us. This was very interesting, and thank you all for coming, and we hope to see you all again in 2 weeks. Bye.
All right. Thank you.